Australian silver isn't moving through New York anymore. It's going straight to Shanghai. And by the time American buyers see the price update, the metal is already on a container ship heading west. This isn't about trade routes. It's about the physical market detaching from the paper price. Let me show you what's actually happening. For the past 18 months, I've been watching settlement flows, vault inventories, and premium spreads across 3 continents. The pattern is unmistakable. Australia produces roughly 450 tons of refined silver annually. In 2024, 65% of their semi-manufactured output went directly to India and other Asian markets. That's not historical. 5 years ago, that same metal would have cleared through London or been routed to COMEX-approved refiners. Today, it never touches Western vaults. The public story is straightforward. China's industrial demand is growing. Solar installations require silver paste. Electronics fabrication needs conductivity. Australia, being geographically closer to Asia, naturally ships east. End of story. That's not what actually happened. The real trigger was a pricing mechanism that broke in late 2023. Let me walk you through how the system was supposed to work, then show you the exact point where it stopped functioning. Under normal market structure, silver moves based on arbitrage. If Shanghai trades at a premium to COMEX, someone buys in New York, ships the metal, and captures the spread. Transportation costs $2 per ounce. Insurance adds 50 cents. You need a premium of at least $3 to make the economics work. This arbitrage keeps regional prices aligned within a reasonable band. That band held for decades. In November 2023, the Shanghai premium hit $4. Arbitrageurs should have flooded the market. They didn't. By March 2024, the premium was $6. Still no flood. By December 2025, Shanghai was trading $8.13 above COMEX. That's an 11% premium on a commodity that's supposed to trade globally at parity. Here's the critical point. That premium isn't closing because the metal isn't moving. Let me explain the constraint. To ship silver from Australia to New York, you need 3 things. First, refining capacity that produces COMEX deliverable bars. Second, vault space in a COMEX-approved warehouse. Third, financing for the metal while it's in transit and storage. Australia has the refining capacity. Perth Mint quotes are currently running 10 to 14 weeks for new bar production, up from the normal 2 to 4 weeks, but they can produce. The constraint is in New York. COMEX registered inventories, the portion of silver immediately available for delivery, hit 531.9 million ounces in late 2025. That sounds like abundance, but registered doesn't mean liquid. Those bars belong to specific entities. They're earmarked. They're committed. They're spoken for by contracts that haven't settled yet. The free float, the metal that can actually respond to new demand, is substantially smaller. London is worse. By October 2025, the LBMA's true free float, the silver not already committed to unallocated account holders, collapsed to approximately 155 million ounces. That's 6 weeks of global consumption. Stay with me. This is where it changes. Australian refiners face a decision. They can ship silver to COMEX-approved vaults in New York, where it sits for 10 to 12 weeks, earns no yield, and competes with 500 million ounces of registered inventory for buyers who are increasingly rolling contracts rather than taking delivery. Or they can ship to Shanghai, where the metal clears in 3 weeks, trades at an $8 premium, and industrial buyers take immediate physical possession. The economics aren't close. An Australian refiner shipping to Shanghai captures the full premium minus transport. Call it $6 per ounce of pure profit. Shipping to New York means competing for COMEX spot price, absorbing storage and insurance and hoping someone takes delivery before the contract expires. That's why the metal moves east, not because of Chinese solar demand, because Western futures markets stopped being competitive venues for physical settlement. Now let's talk about what this means for the pricing mechanism. Silver has always traded with a certain amount of regional variation, small premiums for coins, slightly higher costs for retail bars. These were friction costs, 2 to 5%, manageable, predictable. What we're seeing now is structural divergence. Physical metal trades at one price in Asia, paper contracts trade at another price in New York and London. The gap is persistent, it's widening, and it's not responding to arbitrage the way the textbooks say it should. This happens because of leverage. COMEX silver contracts represent 5,000 ounces each. Traders post 4% margin. That means for every dollar of actual capital, they control $25 of silver exposure. It's efficient. It's liquid. It's also entirely dependent on the assumption that most contracts will never convert to physical delivery. Here's the math. As of January 2026, COMEX has roughly 223 million ounces of open interest in silver futures. Registered inventory is 531 million ounces. That's a ratio of 2.4. Seems safe. But nearly 80% of that registered inventory has never moved. It sits in the same warehouses, owned by the same entities, month after month. When you strip out the static inventory and look at the metal that actually circulates, the ratio flips. There are now 4.2 ounces of paper claims for every ounce of deliverable silver that can realistically change hands. That leverage works perfectly until someone wants the metal. Let me show you the scenario that keeps risk managers awake. Assume 10% of open interest holders decide to take delivery. That's 22 million ounces. Seems reasonable. In a normal month, maybe 2% take delivery. 10% is stress, but not catastrophic. Except it is, because the metal that can actually move is perhaps 130 million ounces, not 531. So 10% of open interest demanding delivery would claim 17% of available supply. At that point, you have three outcomes. First outcome, prices spike to ration demand. Delivery requests cost more. Sellers demand premiums. The exchange remains functional, but the cost of physical diverges sharply from the futures price. This creates the Shanghai premium we're already seeing. Second outcome, the exchange modifies contract terms. They switch to cash settlement. They extend delivery windows. They change bar specifications to allow non-standard deliveries. This has precedent. In March 2020, COMEX Gold faced a delivery crisis when pandemic logistics prevented refiners from converting 400-ounce London bars to COMEX spec 100-ounce bars. The exchange granted temporary exceptions. It worked. It also exposed the system's fragility. The third outcome, someone fails to deliver. A bullion bank or market maker can't source the metal. They default. Regulators step in. Trading halts. The entire pricing mechanism freezes while authorities figure out how to unwind the positions. Outcome 3 is unlikely, but not impossible. Outcome 2 is plausible and would preserve market function while destroying confidence. Outcome 1 is already happening. The question is how far it goes. This is not a conspiracy. This is not manipulation. This is a leverage system encountering physical constraints. Think of it like a crowded bar with one exit. Under normal conditions, people leave gradually. The exit handles the flow. Now imagine someone pulls a fire alarm. Everyone rushes the exit at once. The door doesn't get bigger, people get stuck. The same number of people need to leave, but the exit can't handle simultaneous demand. That's what's happening in silver. The exit is COMEX and LBMA physical delivery. The fire alarm is the realization that paper prices don't reflect physical availability. Here's what makes it nonlinear. As long as most traders believe they can convert to physical if needed, they're comfortable holding paper. The moment that confidence cracks, even slightly, everyone tries to convert at once. It's a self-fulfilling spiral. Doubt creates demand. Demand exhausts inventory. Exhausted inventory confirms the doubt. This brings us to the split reality. In New York and London, silver trades at $71 per ounce. The futures curve is slightly inverted. Lease rates are elevated but manageable. The LBMA quotes spot. Banks provide liquidity. Everything appears normal. In Shanghai, silver trades at $80. The Shanghai Futures Exchange is in violent backwardation, meaning near-term delivery costs more than future delivery. Industrial buyers are queuing for metal. Vault inventories have dropped 56% in 51 days. That's not normal. That's panic buying. These are the same physical commodity. Same purity, same fungibility, yet they trade at an 11% spread. This cannot persist indefinitely. Either arbitrage closes the gap, which requires physical metal to flow from west to east, or one of the prices is wrong. If arbitrage can't close the gap, that tells you something fundamental. The metal isn't available at the Western price. The paper price is theoretical. Stay with me. Australia is now part of this bifurcated market. Their refiners see the Shanghai premium, they see the COMEX stagnation, they make the rational choice. Ship east, capture the premium, avoid the queue. American buyers, the ones who still want physical, now face a constrained market. They're not competing with Shanghai on price, they're competing on allocation. The metal that does arrive in New York is already spoken for by industrial users, commercial hedgers, and large financial entities. Retail buyers, small funds, individuals, they get what's left. Which increasingly is very little. Premiums tell the story. Wholesale physical silver over COMEX spot used to run $1 to $2 per ounce. That's cost plus margin for a dealer. As of December 2025, wholesale premiums are $6 to $10. Retail premiums on generic rounds are $12 to $15. On recognizable products like American Eagles or Canadian Maples, premiums exceed $20. That means a retail buyer in the United States is paying $91 per ounce for metal that is quoted at $71 on COMEX. They're absorbing the entire Shanghai premium plus dealer markup. The arbitrage isn't being captured by traders. It's being extracted as friction by everyone in the supply chain. Now let's assign probabilities to how this resolves. Fantasy outcome. Global mine supply surges, recycling accelerates. New discoveries come online, inventories rebuild. Shanghai and COMEX converge back to parity. The system rebalances without trauma. Probability of this happening in the next 18 months, less than 5%. Mine supply takes 7 to 10 years to respond. Recycling is already at a 12-year high. There's no buffer. Corrupt outcome. Exchanges modify contract terms to prevent physical delivery stress. Cash settlement becomes mandatory. The price discovery mechanism shifts entirely to paper markets. Physical silver trades in dark pools or bilaterally. Transparency collapses. Markets fragment. Probability 20 to 25%. This would preserve institutional function but destroy retail confidence. Managed outcome. Prices rise to ration demand. Shanghai and COMEX both reprice higher, but the premium persists. Australian and other export-oriented producers continue routing to the highest bidder. Western buyers adapt by paying higher premiums or switching to paper exposure. The system limps along in a perpetual state of tension. Probability 65 to 70%. This is the path of least resistance. It's already underway. Here's what this means for you. Do not panic. Markets adapt. Prices adjust. Metal continues to trade. But understand what you're buying. If you hold physical silver, you own the asset that's scarce. Your metal is not subject to contract rollover, cash settlement, or exchange rule changes. You took delivery. You removed it from the system. That position becomes more valuable as the paper-physical spread widens. If you hold silver ETFs or futures, you own a claim on metal that may or may not be deliverable under stress. Most of these instruments will function fine under normal conditions. But normal conditions are not what we're discussing. Understand your counterparty risk. Read the prospectus. Know whether your shares can convert to physical or only to cash. If you're buying new silver, be prepared to pay premiums. The days of spot plus $2 are over. Dealers are not gouging you. They're passing through the actual cost of sourcing metal in a market where wholesale premiums are $6 to $10. If you want immediate delivery, you're competing with industrial buyers who need the metal for production. That competition has a price. 3 indicators to watch. First, Shanghai premium over COMEX. If it widens past $10, physical stress is intensifying. If it narrows below $5, arbitrage is functioning again and the system is stabilizing. Second, COMEX registered inventory changes. Week-to-week fluctuations are normal, but sustained declines of 10% or more over a quarter indicate persistent physical demand that is not being replenished. That's a red flag. Third, lease rates. Silver lease rates are the cost of borrowing metal. Normal levels are 1 to 2%. In December 2025, lease rates hit 7 to 8%. That's not panic, but it's stress. If lease rates exceed 10% and stay there, someone is scrambling for metal. Check these once a week. Don't obsess. Don't trade on daily noise. But pay attention. Zoom out for a moment. Silver is not an isolated story. It's part of a broader shift in commodity markets. For decades, Western financial centers controlled price discovery through derivatives markets. Chicago, London, New York. These venues set the price. Physical markets followed. That dominance is eroding, not because of policy, because of leverage limits. When paper markets expand beyond their physical backing, they lose credibility. Participants start questioning whether the price reflects reality or just the marginal cost of rolling contracts. Once that doubt takes hold, physical markets reassert themselves. China recognized this years ago. They built the Shanghai Gold Exchange as a physical delivery market. They encouraged domestic refiners and industrial users to trade there. They absorbed the liquidity costs and waited. Now, Shanghai's physical premium is signaling to the world that COMEX prices don't reflect Asian demand. That signal is reshaping flows. Australia's refiners are following the signal. They're businesses. They optimize for revenue. If Shanghai pays more and settles faster, they ship to Shanghai. It's not ideological. It's economic. This is the same dynamic that reshaped oil markets in the 1970s, when OPEC broke the dominance of the Seven Sisters, or treasury markets in the 2000s, when Asian central banks became the marginal buyer of U.S. debt. Commodity flows follow financial power. Financial power is moving east. The question is not if this continues. The question is how long Western paper markets can maintain price authority while physical settlement moves to Asia. Eventually, the price that matters is the price where metal actually changes hands. That price is in Shanghai, not New York. For American buyers, this means adjustment. You're no longer in the primary market. You're in the secondary market. The metal arrives after Asia takes its share. Premiums reflect that reality. Delivery times reflect that reality. Availability reflects that reality. Some will find this frustrating. Others will adapt by shifting to different assets or accepting higher costs. The market doesn't care about preferences. It cares about supply and demand. What you should understand is this. The price on your screen, the COMEX quote, the spot number that updates every few seconds, that's an information signal. It's useful. It's liquid. But it's not the full picture. The full picture includes the $8 Shanghai premium, the $12 retail premium, the 10-week refiner delay, and the 56% Shanghai inventory drawdown. All of those are prices. They're just not the price that gets quoted. When you see silver at $71 on COMEX and hear someone say it's expensive, ask yourself expensive compared to what? Compared to paper claims, maybe. Compared to immediate physical delivery in Asia, it's cheap. The market is telling you there are two realities. One is financial, one is physical. They're diverging. The assumption that held for decades was that these two realities would always converge through arbitrage. Enough financial players with access to capital and logistics to keep the prices aligned. That assumption is breaking. Not because arbitrage doesn't work in theory, because the metal isn't available at the paper price. Australia's silver goes to Asia first because Asia pays physical prices. American buyers get what's left because they're paying paper prices plus friction. If you want guaranteed access, you need to pay the physical price. If you're comfortable with paper exposure and understand the settlement risk, the paper price is fine. Just don't confuse the two. This is the new structure. It's not temporary. It's not a dislocation that will resolve in 60 days. It's a repricing of silver from a financially traded commodity to a physically constrained industrial input that happens to also have monetary properties. The adjustment is happening now. Australian flows are the leading indicator. Watch what they do, not what exchanges say. Refiners move metal to buyers who pay the best price and settle the fastest. Those buyers are in Asia. American buyers are in the queue. The question is not if this continues. The question is how long before participants fully internalize that the paper market and the physical market are no longer the same market. They're two parallel systems with occasional connection points. One is settled in dollars and contracts. The other is settled in kilograms and vault receipts. Most people will continue using the paper system. It's convenient, it's liquid, it's familiar. A smaller group will insist on physical. They'll pay premiums. They'll wait for delivery. They'll store it. Both approaches are valid depending on your goals. What's not valid is assuming you can switch between them costlessly whenever you want. That optionality has a price now. It's called the premium. It's called the delivery delay. It's called the Shanghai spread. Australia's silver goes where the market price is real. American buyers are discovering that the market price isn't where they thought it was.